Welcome to our information session on the fundamentals of the National Greenhouse and Energy Reporting Scheme. In this session, we will be going through key topics that are important to the effective administration of the National Greenhouse and Energy Reporting Scheme, or the NGER scheme for short. We will start by running through some key terms that will be used throughout the session. These terms are the agency, we, CER, and us, all refer to the Clean Energy Regulator and may be used interchangeably. NGER refers to the National Greenhouse and Energy Reporting Scheme. NGER Act refers to the National Greenhouse and Energy Reporting Act 2007. Regulations refers to the National Greenhouse and Energy Reporting Regulations 2008. Determination refers to the National Greenhouse and Energy Reporting Measurement Determination 2008. EERS refers to the Emissions and Energy Reporting System, our online system for reporting emissions and energy data. And the department refers to the Department of Climate Change, Energy, the Environment and Water. The Clean Energy Regulator was established in 2012 and is comprised of an independent statutory authority which is made up of a chair, board members and the agency, which conducts the legislative administration of various schemes relating to emissions reduction and renewable energy. The Clean Energy Regulator's responsibilities include providing education and information on the schemes we administer, monitoring, facilitating and enforcing scheme compliance, collecting, analysing, assessing and publishing information and data, and accrediting auditors and working with law enforcement and other regulatory bodies to ensure the integrity of carbon and renewable energy economic markets. The Clean Energy Regulator sits within the portfolio of the Department of Climate Change, Energy, the Environment and Water. The schemes we administer include the Australian Carbon Credit Unit Scheme, the Renewable Energy Target, the NGER Scheme and Safeguard Mechanism, the Nature Repair Market, and the Guarantee of Origin. Broadly, this webinar aims to cover an overview of NGER and some of the key NGER concepts. In particular, the NGER reporting thresholds, which entity holds the reporting requirements under NGER, and what is reported, including reporting methods. We will also touch on the CER's approach to compliance, an introduction to the safeguard mechanism and the product guarantee of origin scheme. There are additional resources on the Clean Energy Regulator website that cover these topics in greater detail. This section will provide an overview of the NGER scheme covering the scheme establishment, relevant legislation, and the publication and use of NGER data. The NGER scheme was established by the NGER Act in 2007 as a single national framework for reporting and sharing data on greenhouse gas emissions, energy production, energy consumption, and other information specified under the NGER legislation. The object of the national framework is to inform and assist government policy formation, inform the public, meet Australia's international reporting obligations, and avoid duplication. In 2016, the safeguard mechanism was added to the scheme and reformed in 2023 to contribute to the achievement of Australia's greenhouse gas emissions reduction targets by ensuring that large industrial facilities deliver a proportional share of Australia's emission reduction targets. The three pieces of NGER legislation relevant for this webinar are the National Greenhouse and Energy Reporting Act 2007, the National Greenhouse and Energy Reporting Regulations 2008, and the National Greenhouse and Energy Reporting Measurement Determination 2008. As an overview, the Act gives the power that enables NGER. The regulations say what should be included in a report, and the measurement determination gives details of how to measure emissions and energy. In a bit more detail, the NGER Act establishes the framework for the NGER scheme and gives the Clean Energy Regulator the legal authority to require corporations to report their energy and emissions data. The Act also enables several instruments which provide information about corporations' obligations. The regulations set out more details about what is required under the NGER scheme, including further definitions of key concepts like defining a facility, details on what is to be included in applications under NGER, like an application for registration, and what must be provided in reports under the Act, like what activities and information need to be included. The measurement determination describes the methods, standards, and criteria to be applied when estimating greenhouse gas emissions, energy production, and energy consumption. The measurement determination is updated annually to make sure that it remains up to date in terms of technology, measurement practices, and data inputs. The NGER Audit Determination 2009 and the NGER Safeguard Mechanism Rule 2015 are also enabled by the Act. The audit determination provides information to auditors about the way that NGER audits are to be conducted. The Safeguard Mechanism Rule sets out the rules and procedures for administering the safeguard mechanism. This video will not cover the audit determination or the Safeguard Mechanism Rule. We will now look at NGER data publication and uses. Data collected under the NGER scheme is used to inform national and state and territory policy programs and activities. It also contributes to the Australian government programs that are responsible for international reporting obligations such as Australia's National Greenhouse Accounts and the Australian Energy Statistics and Australian Petroleum Statistics programs. It is also key in underpinning other schemes and policy development such as the Safeguard Mechanism and the Guarantee of Origin scheme. By the 28th of February each year, the agency must publish the name of each person that was registered under the NGER Act during the previous reporting year. At the same time, we also publish corporate Scope 1 and Scope 2 emissions and energy data, and data on designated electricity generation facilities, in addition to net energy consumption for each corporation that exceeds the publication threshold. We also publish highlights of the NGER data set, including breakdowns by state, by industry, and by electricity generation source. Aggregate data is published on the CER website in a series of interactive charts as the example shown here. This is an example of the data highlights published by the CER tracking Scope 1 and Scope 2 emissions and energy consumption over reporting years. Note, this is not all of Australia's emissions, just those captured by NGER. The CER also publishes data for all registered controlling corporations that emitted 50 kilotons or more of carbon dioxide equivalent emissions from its corporate group. Data is also published in table form for controlling corporations and electricity sector emissions and energy production. The CER will only publish data about registered corporations that exceeded the publication threshold. For controlling corporations, this is where corporate totals have a combined Scope 1 and Scope 2 greenhouse gas emissions equal to or greater than 50 kilotons of carbon dioxide equivalent emissions. This includes data reported under 22X agreements. For reporting transfer certificate holders, data is published where a facility has greenhouse gas emissions with a carbon dioxide equivalent emissions of 25 kilotons or more, or production of energy of 100 terajoules or more, or consumption of energy of 100 terajoules or more. We also publish facility-level data about grid-connected electricity generators. We will now go through some key concepts for NGER reporting. Thresholds for reporting under the NGER scheme are a key concept that needs to be understood. A controlling corporation needs to register if it meets one or more of the thresholds in Section 13 of the NGER Act. Either a facility threshold relating to a single facility, or a corporate group threshold relating to all facilities within the group of companies under the controlling corporation. A registered controlling corporation is required to submit an emissions and energy report annually under Section 19 of the NGER Act. This graphic demonstrates the difference between the facility and corporate thresholds. If a single facility meets a threshold for either emissions, energy production, or energy consumption, then the controlling corporation must register. The facility thresholds are 25,000 tonnes or more of carbon dioxide equivalent Scope 1 and Scope 2 emissions, or 100 terajoules or more of energy consumption, or 100 terajoules or more of energy production. Energy production and energy consumption need to be considered separately to Scope 2 emissions for the purposes of NGER. Energy consumption is more than just electricity use. It also includes the energy content from other sources. For example, combustion of fuels like petrol, diesel, or natural gas. Energy consumption and energy production thresholds apply regardless of source, even if all energy being measured relates to renewables. Registration is required if any of the thresholds are met. For example, a renewable power station may produce over 100 terajoules of energy, but be below the threshold of 25,000 tonnes of carbon dioxide equivalent Scope 1 and Scope 2 emissions, in which case the relevant controlling corporation must still register. There are additional reporting obligations on Australia's largest emitters under the Safeguard mechanism. The Safeguard threshold is more than 100,000 tonnes of carbon dioxide equivalent covered Scope 1 emissions. The corporate thresholds apply to all facilities within an entity's corporate group, including facilities that are under the operational control of any subsidiaries and group members of a controlling corporation. The corporate threshold is double that of the facility threshold. The corporate threshold applies regardless of whether a facility threshold has been met, and vice versa. For example, a company with a large number of small facilities, for example a retail chain, may exceed a corporate threshold without exceeding the facility threshold. The key takeaways when reviewing thresholds are: assess your operations at both the facility and corporate group levels, consider all relevant emission sources, and assess energy production and energy consumption separately to Scope 1 and Scope 2 emissions. Many companies exceed thresholds related to energy consumption or production in the first instance rather than the emissions threshold. For energy measurement, there are factors to consider beyond the purchase of production of electricity. For example, the combustion of fuels has both emissions and energy consumption outcomes. The CER has a threshold calculator on its website that has emissions and energy factors built in to assist in assessing whether you need to register. This slide contains some examples for demonstration purposes that were assessed using the NGER calculators. These examples are based on very rough average numbers derived from open source information and meant to be illustrative in nature rather than determinative. It is important that entities accurately assess with regard to their own circumstances. In example 1, we can see that combustion of diesel in large quantities is likely to exceed the energy consumption thresholds before the emission thresholds. For example 2, we can see that a solar farm or a collection of solar farms operating at 50 megawatts is likely to exceed the corporate threshold for energy production. A single solar farm at about a third of that size would trigger a facility threshold. Likewise, a 50 megawatt rated data center is likely to exceed both the emissions and energy consumption thresholds. It is noted that the data center is in New South Wales, as Scope 2 emissions are calculated on the average Scope 2 for the network in each jurisdiction. These assumptions are built into the threshold calculator. Note the NGER calculators are updated regularly. It is important to use the correct version for a reporting year. When assessing your NGER reporting obligations, it is important to correctly identify the members of the controlling corporations group, consider both facility thresholds and corporate group thresholds, ensure all relevant entities are identified, including subsidiaries, joint ventures, trusts, or foreign corporations. Consider all relevant emission sources, energy consumption and energy production, and renewable energy sources. A controlling corporation is a constitutional corporation that does not have an Australian incorporated holding company above it. It is typically the highest corporation in an Australian corporate group, but it may also be a non-operational holding company or a foreign incorporated entity operating directly in Australia. The controlling corporation must register under Section 12 of the NGER Act if any of the NGER reporting thresholds are met by the corporate group. Where there has been a restructure or change in ownership, organisations should review their corporate structure to ensure the correct controlling corporation is registered. Correctly identifying all members of the corporate group is essential, as this determines which facilities must be reported under the NGER Act. A corporate group may consist solely of the controlling corporation or include one or more group members. An affected group entity is a subsidiary of the controlling corporation that has operational control of a facility or has a subsidiary that does. Where the controlling corporation is a foreign incorporated corporation with direct operational control of a facility, they will not have any group members. Operational control rests with the entity that has the greatest authority to establish and implement operating policies, health and safety policies, and environmental policies. Operational control may differ from day-to-day management. For example, a contractor or franchisee may manage daily operations, while operational control remains with the entity responsible for setting and enforcing the relevant policies. In some circumstances, such as unincorporated joint ventures, more than one party may have authority over these policies. The NGER legislation provides guidance on determining operational control, with further information available in the Operational Control Guideline available on our website. In this example, Company A holds all the shares in Company B, but does not have operational control over any facilities. Therefore, it cannot be a controlling corporation, as foreign incorporated corporations can only be controlling corporations where they have direct operational control of a facility. In this case, as the highest listed Australian organisation, Company B is the controlling corporation. Companies C and E are group members as they have operational control of a facility. Company D is a group member as it has a subsidiary that has operational control of a facility. As the controlling corporation, Company B must register if it exceeds any of the thresholds. Company B must include details of Company C, D, and E in their report as they are all affected group members. Once you have identified the controlling corporation and group members, you need to identify and apply the definition of a facility to your circumstances. In general, a facility is an activity or series of activities, including ancillary activities that involve the production of greenhouse gas emissions, the production of energy, or the consumption of energy, forms a single undertaking or enterprise and meets the requirements of the regulations, and is attributable to a single industry sector. Correctly identifying and applying the definition of a facility to your circumstances will require the examination of a number of parts of both the NGER Act and the NGER regulations. What constitutes a facility is broad, and the NGER Act and the NGER regulations cover several varied and complex situations. They are designed to provide corporations with a degree of flexibility in applying the definition of a facility to their own specific circumstances. Corporations must keep records of their decisions and the reasons for them. The ANZIC codes are listed in Schedule 2 of the NGER regulations. Where there are multiple activities, the principal activity must be defined. The principal activity is the activity that results in the creation of a product or service for sale on the market and that produces the greatest value of all the activities in the series. The legislation does not define activity, series of activities, or ancillary activities. Using the Macquarie Dictionary definitions, an activity is a specific deed, action, or function. A series of activities is a number of deeds, actions, or functions that occur in succession or in a particular order, and an ancillary activity is an accessory or helping thing. Corporations should apply these concepts when determining the boundaries of a facility. A facility is not necessarily limited to a physical place or thing. For example, there could be numerous facilities within a single commercial building, or a single facility could be made up of numerous commercial buildings. The boundaries of a facility will vary depending on the activities that take place within the commercial buildings and the group members with overall control of these activities. Facility boundaries should not be changed in a way that would avoid or minimize coverage under the safeguard mechanism. The CER has powers under the anti-avoidance provisions of the NGER Act to prevent this by defining facility boundaries. The regulations set out the different circumstances in which an activity or series of activities will form part of a single undertaking or enterprise. Examples of circumstances in the regulations include, but are not limited to, occur at a single site, are listed activities undertaken away from the main site but attributed to that site, are transport sector activities that may operate across multiple locations, are electricity, gas, water, sewerage or telecommunications activities, or multi-site cement production activities. Corporations will also need to consider activities that must be attributed to a particular industry sector when defining a facility. This includes construction of infrastructure for the purpose of another activity being undertaken in the future if it is also under the overall control of one person. In this example, the various activities form a facility on a single site, as there is a primary activity, winemaking, with ancillary activities, grape growing, transport, and administration. There is a secondary activity, olive growing, which is separate, but some of the products are used in the primary production process, for example, making wine marinated olives. All processes are under the overall control of a single entity. Therefore, these can be grouped as a single facility. Sometimes single site requirements are not practical. For example, transport activities are non-stationary in nature, and it is difficult to apply the single site definition. Regulation 2.19 states that transport activities will form part of the same single undertaking or enterprise, provided that the principal activity is attributed to one of the industry sectors detailed in this regulation, the activity is attributed to a single state or territory, and the activity and its ancillary activities are under the overall control of the same corporation. Another example would be electricity, gas, sewerage, and telecommunications activities. Regulation 2.20 states that these activities will form part of a single undertaking or enterprise, provided that the principal activity is attributed to one of the industry sectors detailed in this regulation, and the activity and its ancillary activities are under the overall control of the same corporation. For transport facilities, the activities are required to be in the same state or territory, whereas network and pipeline facilities may cross state or territory boundaries. However, corporations may nominate a national transport facility under Regulation 2.19a. Under Regulation 2.19, road freight activities can be grouped under a single facility if they are within the same state or territory and under the overall control of the same company. For a transport facility, the activity is reported based on where fuel is purchased rather than where it is used. In this example, a transport company which operates hubs in mainland capital cities may either report each state facility separately or nominate a national transport facility under Regulation 2.19a. A controlling corporation may be eligible to be deregistered if it is below threshold and not likely to meet any of the thresholds under Section 13 of the NGER Act in the following 3 financial years, or no longer meets the definition of a controlling corporation, which could be the result of a corporate restructure, merger, or takeover, or they were registered incorrectly as it didn't meet the definition of a controlling corporation at the time of registration. Applications for deregistration are available via online services. Please note that in order to submit a deregistration form, you will need to be acting on behalf of the corporation you wish to deregister. It is important that organisations review their corporate structure each year and update EERS to reflect any changes. Organisational changes that occur on or after 1 July will need to be reflected in that year's financial report. This includes any new or disposed of facilities and that the correct group member is listed as having operational control over relevant facilities. There are 3 situations where acquisitions or mergers can affect an organisation's reporting requirements. These are change of ownership of a group member, change in operational control of a facility, or change in ownership of a controlling corporation. Part year reporting applies where operational control of a facility has changed. Responsibility for reporting on part year activities will rest with the controlling corporation that owns the relevant group members as at 30 June, including group members that have been wound up or liquidated while part of the registered corporation's group. In this instance, each controlling corporation reports on the part of the year that it had operational control. Part year reporting does not apply where ownership of a group member changes and there is no change to operational control, or there is a change in ownership of a corporate group and operational control of all facilities in the corporate group remains the same. The following slides contain examples of where part year reporting is required. For example, Facility B is owned by and under the operational control of Group Member B. If Group Member B, together with Facility B, are sold to a new corporate group, controlling Corporation B, and Group Member B continues to have operational control over the facility, then the new controlling corporation will have reporting responsibilities for Facility B for the full year. In this instance, as operational control has not changed, part year reporting does not apply. Controlling Corporation A would report on the other group members and facilities in their corporate structure that were not involved in the sale. Controlling Corporation B would report on the activities of Facility B for the full year. Each of the controlling corporations will need to review their corporate structures in EERS to ensure that they are reporting on all their facilities and group members. If operational control of a facility changes from one person to another, part year reporting applies. For example, a facility is sold partway through the 2025-2026 reporting year, and operational control also passes to the new owner or another group member. In these instances, controlling corporations are only required to report on the activities of members of their corporate group for the period they had operational control. In this instance, operational control changed on 1 January 2026. Controlling Corporation A will report on the facility's activities from 1 July 2025 until 31 December 2025. Controlling Corporation B will report on the facility's activities from 1 January 2026 until 30 June 2026. We will now look at what is required to be reported under NGER. Emissions under the NGER Act relates to Scope 1 and 2 emissions, but does not include Scope 3. This reflects the purpose of NGER in contributing to the national greenhouse gas accounts. As noted previously, energy production and consumption is also counted alongside emissions. The NGER scheme only covers facilities within Australia as defined by the Act. Only emissions and energy sources with published methods or measurement criteria in the NGER measurement determination need to be reported. Currently, there are no methods published for agriculture, land use change, or forestry. Note the lack of methods for these areas does not exempt agriculture or forestry entities from reporting other sources where a reporting threshold is met, for example, diesel consumption for transport. We will now look at types of reporting under the NGER scheme. As mentioned earlier, the majority of NGER reports are made under Section 19. However, there are other types of reports. A Section 22X report, which is where a group member takes on reporting obligations for their facilities, and a Section 22G report, which is where the organisation that has financial control over the facility takes on reporting obligations for their facilities. The reporting deadline for all NGER reports is 31 October. There is no provision in the NGER Act for extensions to this deadline. All reports are submitted using the Emissions and Energy Reporting System EERS. EERS is accessed via our online services platform. A Section 22X agreement allows a controlling corporation to transfer its Section 19 reporting obligations to other members within its corporate group. The group member taking on reporting obligations must have operational control over the facilities that are the subject of the agreement. To transfer reporting obligations, the controlling corporation and the group member must enter into a written agreement to transfer the reporting requirements for the specified facilities. There is no set template for the agreement, as it is up to the parties involved to determine this. There is no formal application process for notifying the agency of a 22X agreement. However, the parties entering the agreement must notify the agency in writing before the end of the financial year to which the agreement relates. Unless the 22X agreement specifies the circumstances under which the agreement will no longer have effect, the agreement continues to be in place even when circumstances change. A notification to the agency advising that an agreement has ceased must be done in writing prior to the reporting deadline. In this example, Company A enters into a 22X agreement with Company B in relation to Facility 1. Company B is responsible for reporting emissions and energy data for Facility 1. Company A must still report for Facilities 2 and 3 and include a list of all facilities that are reported under a 22X agreement. The reported emissions and energy data for Facility 1 will be added to Company A's corporate total once both Company A and B have submitted their reports. Note, the 22X agreement in this instance cannot have Company B report for Facility 2 or 3, as these are not under its operational control. Separate 22X agreements would need to be put in place for Company C and Company D. A Reporting Transfer Certificate, or RTC, allows reporting obligations to transfer from a corporation with operational control over the facility to the corporation that has financial control over the facility. RTCs relate to single facilities only. This means if a corporation wishes to take on reporting obligations for multiple facilities, the corporation will need to obtain an RTC for each facility. The application form is available on our website. The applicant must have financial control over the facility. Financial control is intended to encompass a corporation that has significant ability to control a facility through financial means only, and therefore give effect to decisions relating to greenhouse gas emissions reductions. To be eligible for an RTC, an applicant must first pass the reporting transfer test in relation to a facility. The requirements of the test can be found in Section 22J of the Act. An RTC holder may, with the written consent of the agency, surrender its RTC. The surrender takes effect from the date the agency gives consent. The agency may also cancel an RTC in certain circumstances. Corporations are required to report on all activities that make up the facility. These activities can come from many sources depending on the facility, including information relating to the activities of contractors and subcontractors. Activities of a primary production process are not required to be under the overall control of the same corporation to be considered part of a facility. This means that a facility's reportable activities may include external workers, such as contractors who have been employed to perform activities within the facility. These should be included within the facility's activities when reported. The organisation that has operational control of a facility is responsible for collecting relevant data associated with the facility, including contractor data. It is important to note that the concept of overall control is used when identifying the activity or series of activities that make up a facility. Operational control is used when talking about a facility as a whole. In this example, a contractor is used to provide transport of material from where they are extracted to where they are processed. As the activities all relate to the production of a single product and occur at the same site, they constitute a single facility. Company A has operational control of the facility. As such, Company A, or its controlling corporation, must report emissions and energy data for the whole facility, including the operations of the contractor. In some cases, the activities of contractors can mean additional information needs to be included within your report. If the activities performed by a contractor meet any of the thresholds listed under Regulation 4.30, the reporter is required to provide additional information. This information is entered through the Contractors tab in EERS and submitted as part of your report. The report is required to provide the listed identifying information for the contractor, as well as nominating the energy and emissions involved in the contractor's activities. This additional information about contractors' activities is not included in the controlling corporation's reporter totals. We will now look at using EERS to report under the NGER scheme. EERS is accessed via online services. EERS user access is determined by the NGER permissions each user is assigned in online services. It is important that organisations manage access to their EERS accounts. This ensures the agency can contact the most relevant people from the organisation. At the very least, each organisation must have an NGER contact and an executive officer attached to their organisation. The NGER contact is the first point of contact in relation to the organisation's NGER reporting obligations. This person will also be sent general EERS and NGER information and updates from us. As part of the initial NGER registration process for new controlling corporations, the nominated executive officer and NGER contact person are automatically given an admin role which allows access to the organisation's EERS account, the ability to edit the company's details and corporate structure, and the ability to link additional users via the self-service functionality. Any new NGER contacts or executive officers added after registration will need to be first given the role in online services, that is, executive officer or NGER contact, then given the relevant permissions to manage the organisation's account, and finally given NGER permissions to perform actions within the organisation's EERS account. If an executive officer nominates an individual to submit the report on their behalf, internal records of this decision must be kept. See our online services user guide available on our website for more information. The NGER Act gives the Clean Energy Regulator monitoring and enforcement powers. The agency has developed a compliance approach to make sure we administer laws in a transparent and ethical way. It is important that reporters are aware of their ongoing obligations to report, as well as the importance of record keeping in meeting these obligations. A reporter must keep records of activities for 5 years from the end of the year in which the activities take place. The records must allow accurate reporting and enable the agency to ascertain whether the corporation has complied with their obligations under the Act. This is likely to involve a list of all sources monitored, the activity data used for calculating reported emissions and energy, documentary evidence relating to calculations, including invoices and analytical results, documentation of the collection process for activity data, and documentation of the decision-making process behind data collection, including decisions to include or exclude an activity from reporting, decisions on selection of method, decisions on facility boundary definitions, and decisions on the use of certain standards for sampling or analysis. agency has consistently found through audit reports that organisations that record this information in an accessible, centralised format, sometimes known as a basis of preparation, are more reliably able to meet their obligations under the Act. Basis of preparation guidance is available from our website. While the CER acknowledges that companies can opt to complete financial and sustainability reports on a calendar year basis, there is no discretion in the NGER Act for calendar year reporting or extensions beyond 31 October. This is because the NGER data is used to feed into other processes such as the National Greenhouse Gas Accounts. The CER is also required to publish data by the 28th of February each year for the previous reporting period. The Clean Energy Regulator must receive the report by the statutory deadline. The Acts Interpretation Act 1901 makes provision for the discharge of duty when the due date falls on a weekend or public holiday. In these circumstances, the report may be submitted on the next day that is not a Saturday, Sunday, or public holiday. The penalties for late reporting can be significant, with civil penalties of over $600,000 for late reporting and additional daily penalties for continuing contraventions. The agency encourages voluntary compliance amongst reporters and provides a range of guidance material to help reporters to understand their rights, obligations, and entitlements. The agency also encourages reporters to voluntarily notify us when they have identified reporting mistakes. We view this as an indicator of a positive compliance attitude and a demonstration that the reporter is committed to meeting its obligations under the legislation and to providing accurate and complete data. The CER aims to assist reporters to be compliant with their requirements under the National Greenhouse and Energy Reporting Act. This includes providing education and assistance. If you have questions, we encourage you to contact us. Where there is ongoing or serious non-compliance, the CER has a number of enforcement options available, including publishing of late reporters, infringement notices, and civil penalties. In summary, corporations that are registered as NGER reporters must report their greenhouse gas emissions, energy production, and energy consumption for every financial year. The first year of reporting for an NGER participant involves identifying the controlling corporation, its group members, and facilities, and determining whether any of the Section 13 thresholds have been exceeded. If an NGER threshold is met for a financial year, the controlling corporation must apply to register by 31 August following the trigger year. Registration is only required once for a controlling corporation. For each reporting year, once EERS opens in early July, reporters must review and update their corporate structure in EERS. This includes identifying any new or disposed facilities, confirming which group member has operational control of each facility, and ensuring all relevant group member details are recorded. Once the corporate structure is up to date, reporters can enter data into EERS, generate their report, and the executive officer can submit it. In some instances, part year reporting may apply where operational control of a facility changes during the reporting year. In these circumstances, each controlling corporation must report on the facility for the period in which it had operational control. Further guidance on part year reporting is available on our website. A registered corporation is required to submit a report each year, even if its corporate group falls below the reporting threshold. In these cases, emissions and energy data may not be required. However, contact details, corporate structure information, and facility locations must still be reviewed and updated. If, after review, it is unlikely a corporation will meet NGER thresholds for 3 or more consecutive reporting years, or no longer meets the definition of a controlling corporation, or is incorrectly registered or has ceased to exist, it may apply for deregistration, provided there are no outstanding NGER obligations. If a corporation is deregistered by 31 October, it will not have to report for the most recent financial year. The Reporter Support Dashboard contains key information and resources for NGER reporting, such as reporting guides and calculators. You can find links to all of these resources in the video description. This section will include a brief introduction to the Safeguard Mechanism. The Safeguard Mechanism is the Australian Government's policy for reducing emissions at Australia's largest industrial facilities. It sets legislated limits, known as baselines, on the Scope 1 greenhouse gas emissions of these facilities. The Safeguard Mechanism requires facilities that emit over 100,000 tonnes of Scope 1 emissions per annum to keep their net emissions at or below a prescribed emissions limit known as a baseline. The Safeguard Mechanism has been in place since 1 July 2016 and it was reformed on 1 July 2023. The reforms have changed the scheme so that baselines reduce each year in line with Australia's international emissions reduction targets, which are that Australia reduces its emissions by 43% below 2005 levels by 2030 and achieves net zero by 2050. The reforms also introduced a new unit type called Safeguard Mechanism Credit Units, or SMCs, to incentivise facilities to reduce their emissions beyond their baselines. SMCs are tradable credits that provide a financial incentive to safeguard facilities to reduce their emissions beyond their baselines. A range of training tools and written guidance documents relating to the Safeguard Mechanism are available on the Clean Energy Regulator website. You can find links in the video description. We encourage you to review these materials, and the Safeguard team can be contacted via CER-Safeguard Baselines at cer.gov.au. The PEGO scheme sits within the broader Guarantee of Origin framework, a voluntary scheme designed to support Australia's low emissions industries and the energy transition. The GO framework has two key components. The first is the Renewable Electricity Guarantee of Origin, or REGO, which tracks and verifies renewable electricity through digital certificates. The second is the Product Guarantee of Origin, which provides trusted information about where a product was produced, how it was made, and its emissions intensity across its life cycle. The remainder of this presentation will focus on the PEGO scheme. The Product Guarantee of Origin scheme provides a trusted framework for tracking and verifying the emissions intensity of products. It enables producers, exporters, and consumers to use digital certificates that verify where a product was made and its emissions intensity across production, transport, and storage, including upstream emissions. This gives Australian producers the confidence to make objective, transparent, and credible claims about the emissions intensity of their products. Renewable gas being claimed does not need to be physically delivered to the facility. Instead, the attributes of renewable gas injected into a shared natural gas network are transferred when consumption information is added to PEGO certificates for the reporting year. To use PEGO certificates under the NGER scheme market-based method, they must include consumption information showing that the renewable gas was consumed at the reporting facility, and they must represent hydrogen or biomethane injected into a natural gas network within the 24 months prior to the end of the NGER reporting year. This diagram shows the 4 steps to claim renewable gas using PEGO certificates. In step 1, the gas consumed by the facility must be supplied through a natural gas network, such as the East Coast Gas Market or the Western Australia Gas Market. The renewable gas may be blended with natural gas within the network, and appropriate contractual agreements must be in place with the renewable gas producer, retailer, or other supply chain participant to support the renewable gas claim. In step 2, to use the PEGO certificates, the facility can either register as a GO participant and hold its own PEGO consumption profile, which would allow the holder to add consumption information directly to the certificates, or arrange for another registered participant, such as a producer, retailer, or aggregator, to hold a consumption profile and add the information on behalf of the NGER reporter. In Step 3, consumption information must be added to the PEGO certificates to demonstrate that the renewable gas being claimed is consumed at the facility. In Step 4, when the NGER facility is preparing its report, it must apply the market-based method to report renewable gas consumption, supported by PEGO certificates, and report only the amount represented by eligible PEGO certificates as renewable gas. The NGER report must clearly identify that the market-based method has been used, evidence the PEGO certificates relied on, and provide the volume of renewable gas represented by the certificates. There are a range of training tools and written guidance documents for further information relating to the Product Guarantee of Origin scheme on the Clean Energy Regulator website. We encourage you to review these materials, and the Product Guarantee of Origin team can be contacted via the email address on the screen. Thank you for watching the NGER Fundamentals information session. If you have further questions, please contact us.